It's been a long shot, but then we'll be looking at how to deal with chapter 3, and it's going to be very short because we hope to close chapter 3 today, so that in the next 4 to 5 lectures we should finish all the 16 chapters, and that's our goal. So we need to run, and we only have for each chapter 1 quiz, because we're going to be running very fast. So please pay attention and try to follow through so that we can meet up with our lecture, our study pack. Okay, so let me share my screen quickly for chapter 3 very quickly. So chapter 3, we're looking at rules of professional conduct for auditors, for chartered accountants, and we have 4 units. We'll be looking at fundamental principles of professional conduct. We'll be looking at integrity, objectivity in unit 2, and independence. We'll also look at confidentiality and conflict of interest. Unit 4, we'll look at corporate financial advice, and that will be it for chapter 3. We'll review it and we'll do just 1 quiz for each chapter. We may not be able to take each quiz for each unit. We are running out of time, so let's run. Okay, so unit 1, talking about fundamental principles, we have integrity. This is just like recap. In several papers, you've had this fundamental principles, case study, corporate reporting, and even on previous skills papers. So integrity is being straightforward and honest in all professional business relationships. It's clear, we know what integrity is. And objectivity has to do with being objective. You are not biased, you are independent, you don't engage in conflict of interest where you have an interest and it beclouds your judgment, or you are unduly influenced to compromise your professional outlook to how you see things. So objectivity is being unbiased in your professional reviews. The next fundamental principle is professional competence and due care. You maintain knowledge and skill for competent service delivery. You act diligently and you follow standards. So one of the professional competencies you are displaying now is these lectures. You're working towards qualification, and being a chartered accountant is a professional upgrade. And you're trying to be competent and be able to know the job of what it entails to be a chartered accountant. You also follow professional international auditing standards, professional standards of accounting, ISAs, IFRS, IES, and other standards that are applicable to your work. And confidentiality, respect information, you don't disclose without due authority, legal professional duty, and you keep information and not use it for personal gain or benefit. That's what confidentiality is all about. Just a recap, we know all this. And also professional behavior, you comply with laws, avoid discrediting the accounting profession. Anything that will bring discredit to the noble profession, you stay away from it. So that's unit 1, basically a foundation or a recap of the 5 professional fundamental principles. So we have integrity, objectivity, professional competence, due care, and confidentiality, and also professional behavior. Are they 5? Integrity 1, objectivity 2, professional competence and due care 3, confidentiality 4, professional behavior 5. Yes, they are 5. Okay, so any question? Like I said, we'll be running. Do we have any questions for that? I believe it's clear and succinct. Okay, so let's go.
So just 1 page, you're doing that 2 pages.
Yes, please. We have to run. Okay, so number 2, integrity, objectivity, and independence. Now, integrity, objectivity, and independence, auditors must be independent in mind and appearance for report value. That's the only way you could objectively provide value. If you don't have integrity and you are not objective and you are not independent of the process you are auditing, then you cannot provide value. It's very important. So what is independence of mind? A state of mind of being unbiased in your conclusions and recommendations. So you've not been influenced by anything, by anybody. That's what independence means. You look at things objectively and you report on it how it's supposed to be or how it is. That's what independence of mind is, without prejudice to who will be affected or who is going to be influenced by your review. And that's what independence of mind means. So you have looked at a report or reviewed it objectively and you've provided unbiased conclusion. Very important. Independence of appearance means avoid circumstances that suggest compromised objectivity. Public confidence in audit process is key. So independence of appearance means nobody is intimidating you. No personality, no board, no person, no posture or personality influences you in appearance. You avoid circumstances that will keep you compromised, tips, bribes, any rebates, anything that will be given to you to jeopardize your judgment. Avoid it. And that's why you have to be independent in your appearance. So public confidence in audit process is key. I've had situations where vendors bring money to me practically, and I tell them why. No, we are just appreciating you. I said, no, I can't do that. Please take it away. What am I doing? I'm protecting my independence of appearance. Because by the time I start receiving those money, somehow, even though it may mean harm, they may not mean harm, they are just appreciating, okay, it comes to the audits and he signs and it goes. Anytime I see those documents, I may be influenced to say, our advice, give this vendor, because he brings returns to me. So you must avoid that in appearance. And I'm not saying what they did was to come and bribe me. They were appreciating me not to sign something. They said, they give management and all that. I say, well, you can give management, but I can't take it, to avoid independence of appearance or to avoid jeopardizing your independence of appearance. So you need to be very, very objective and keep this as an auditor. And threats to these independent situations that could compromise objectivity, number one is self-interest, where you have interest in something as an auditor, financial, gifts, share, like I spoke about gifts now, is a self-interest. You may be in need and somebody brings something to you to review. All of a sudden you collect the money and the next thing, every other reviews, you say they should give it. They're having meetings, procurement meeting, you say give that vendor, so that you can. So those are threats, self-interest. So as an accountant, keep that aside when you're doing your job. Also self-review, reviewing your previous work or judgment, preparing financial statements and also auditing it is a self-review threat. And that is why you cannot prepare financial statements by the same audit firm and also audit it. It has to be two different parties. You can't be the maker and the checker. That's what it means. So you can't review, and that's a self-review threat. You can't make and check. It's very important to keep our objectivity intact. The next one is advocacy, promoting client's position and defending in court or underwriting shares. So allow the client to answer. Your own is to provide independent opinion on the financial statements. Allow the client to maintain the responsibility of preparing the financial statement. Don't advocate for the client as a professional. When I'm being quizzed why I signed something, I defend myself. I don't advocate for management because I'm independent of management as an auditor. I tell the management, explain yourself. I don't say, okay, this is why management did this. No, they explain themselves. I don't advocate for them. And as an auditor, please don't promote a client's position and defend above your objectivity. It appears or impairs independence and objectivity. The next one is intimidation. Intimidation threat, deterred by threats, easy losing your work. You're afraid of losing a client that provides maybe a chunk of your fees, or there is a domineering personality on the board, or a domineering CEO you're afraid of. That's intimidation, and it influences an auditor's judgment. One has to be careful to stay away from this threat. Intimidation threat is popular. Mostly when auditors find issues, they may not want to talk because of the chunk of the money they get from that audit work. They are intimidated. And finally, familiarity. Too sympathetic due to close relationships, long associations, and that is why you have time lags. You shouldn't audit a client for more than a particular amount of years so that you'll not be familiar and you begin to ignore mistakes. Or too much closeness to a client, or you have a family tie or an employee on that employment. We have to be careful. And these specific threats have guidance, like financial interests, assurance, you have a team or family, you hold direct or indirect material interests, disposed or removed team member. Somehow, something is threatening your job as an auditor. So you need to stay independent and be guided accordingly. Very important. Also, what could jeopardize it is loans and guarantee. Avoid loans from clients, except normal commercial bank terms, but from your clients as auditees, you are the auditor, avoid taking loans. It could lead to close ties. Also, close business relationship. Auditors should avoid close relationships, avoid material joint ventures with clients that could influence your review of their financial statements. Also, arm's length commercial transactions are okay. Commercial transactions with audit teams, for example. So you want to buy shares, for example, from that company or from that bank you're auditing. Those are arm's length transactions, but must be normal course of business, not during a material audit engagement. So arm's length transactions are okay as long as they don't influence your decisions in the audit work. Also, family and personal relationships. You need to assess individually immediate family or close relationships with those of your team, those of your client. Be careful not to impair your objectivity. So employment with assurance clients, where you're auditing a client with the view of getting employed and resigning from the firm. Former key audit partners joining a client requires a 12-month gap in law. So if you are resigning from your current audit firm, you can't move immediately to your client as maybe finance manager or director or a board member. You have to have at least 1 year gap and non-involvement in that period's audit. Disclosure of good negotiations is required. So these are rules to stay independent. Not that as you're auditing a client, the client say, oh yeah, come and be our director. You just resign immediately, leave your audit firm and you join the client. It's going to impair independence and objectivity very, very closely. Also, recent service with assurance client. Rotation is very important. Like I spoke about, to avoid familiarity, rotation rules for engagement partners is key. So for most partners, it's 5 years. Move to another partner or move to another firm. Quality control reviewer is 3 years. And where there's a key audit partner is 2 years. So it's very important to take note of this rotation rule to avoid familiarity.
I don't know what you mean by. Can you go back, please?
Yes, please.
You said rotation rules for engagement partner. I don't know, what does that mean?
Okay, very good. So for auditors taking engagement roles, so for example, you are auditing, let me use Julie, Josiah, and Co. So we are auditing Gongoni Nigeria PLC, for example. So Julie Josiah is an audit firm. Now, Julie is the engagement partner. You cannot audit Gongoni Nigeria PLC for more than 5 years at the engagement partner. So after you've engaged and reported on that entity's financial statements for 5 years, you should move it to another partner. So maybe Julie is a partner, Josiah is a partner, so you move it to Josiah, even if it's the same firm. That's what it means.
Okay, that's what you mean. The person going for the audit job shouldn't be the same person for 5 years.
For more than 5 years.
More than 5 years. More than 5 years.
Okay. Exactly. So in the same firm, if you have Julie doing the job for 5 years reporting, Josiah should take over after 5 years, or you move it to an audit firm, a different audit firm. That's what it means. So there should be rotation. So if you are doing quality control review and the person is strictly reviewing quality control of that firm, he shouldn't do it more than 3 years. Move it to another person qualified in that position in your firm for another 3 years. So 3 years is the maximum for quality control review. Then for key audit partnership. So for example, the audit is not a sole proprietorship, is not a limited liability company. So it's a partnership where Julia and Josiah are partners. It should be 2 years reviewing an auditee or a client company. So if Julia has done for 2 years as a partner, the other audit partner should do for another 2 years. And after that, they should cede the job to another audit firm to avoid familiarity.
This is a bit confusing now. Number 1 and number 3 are a bit confusing.
Yeah, so number 1 and number 3. Number 1 is a situation where the company is a limited liability audit firm. So you have a lot of engagement partners. So for example, like KPMG now, you could have 10 engagement partners because it's large. But in a partnership, there may be 3 or 2, depending on the size. It may be a medium size or a small firm. So where it's small, it should be lower time period for them to avoid familiarity. That's what it means. Yes, it should be 2 years.
Okay.
All right. Good question. Thank you. So bring it on. Then talking about the fees, high percentage of fees for ICAN is greater than 25% for 2 consecutive years. So any fee you receive as an auditor that is above 25% for 2 consecutive years, you must disclose it. This is for ICAN. You can see they are clear. They didn't say for ANAN. We don't know for ANAN, but for ICAN licensed firms, if you've received 25% of the audit fees, that means your total 100%. One partner is providing 25% of your yearly, let me say, profits or revenue. You need to disclose it to avoid overdue fees. Yeah. So if one person is providing 25% of the chunk of the money you make in a year, you need to disclose it because there is a risk that you want to retain that client because of the materiality and the volume of the amount. So it has to be disclosed to ICAN so that you will not want to retain that client and you will not do your job properly. Very, very important. So take note of these fees. But if it is less than 25%, you don't need to disclose. So let me go again. Where you have your monthly or yearly income as 100 million and 25 million is coming from one firm, one client, it needs to be disclosed. That's what it means. Then also inducement. Don't accept gifts, hospitality unless trivial and inconsequential. So for auditors, you can't collect that. You can't take gifts anyhow. You have to be careful. But if it's something immaterial that if it sparks up outrage, you can easily pay it and say, no, I thought it's Coke. Now take the money for the Coke. If it's buying Coke that will make you want to control me, take back your money for Coke. So inducement should be avoided except if it is trivial and inconsequential. Also, actual and threatened litigation may require resignation. Provision of other services, non-audit can also threaten independence and culminate in self-interest and self-review threat. We've spoken about that. So where you have litigation issue and you see it staring at the face during your engagement, you may be required to resign from that engagement. It's very important. Also, provision of other services, that's maker and checker, like I spoke about, is not allowed. You can't make the financial statements and report also or audit it. It is not in line with best practices. It will lead to self-review and self-interest threat. Also, prohibition on assuming management responsibility. So you can't prepare their financial statements or help them install internal controls. No. You allow management their responsibilities. Your job is to audit. Preparing accounting records, financial statement is prohibited for public interest entities. It's allowed for others, maybe small companies, but then for public interest and public listed companies is disallowed. Also, temporary staff assignments allowed with strict conditions. So maybe you have an audit staff that wants to work for a term of 6 months for a client, but there must be strict conditions, and it must be prohibited services, and it doesn't involve management decisions or influences the client directly. So there are rules to it. Also, second opinions. Get client permission to contact existing auditor. Refuse if not given. So what does this mean? Second opinions means you get the client's opinion or permission to contact the existing auditor, maybe where you are invited to take over another auditor's job. If you don't contact the other auditor, you cannot accept that engagement from the client. Very important. Also, involvement of specialist valuations. You have to be restricted if material and subjective situations occur. Prohibited for public interest companies if material. So you are involving a specialist that you don't have expertise in that area to value something. If it's material, you have to subject that to serious scrutiny. Very important for public interest and public listed companies. In safeguarding our independence as auditors, shared responsibility of auditor, firm, and profession is very important. The culture of independence in the audit firm is key. Also, rotating engagement partners and senior managers, senior staff is essential. Training of staff, quality control, and consultation procedures, very important. Action to resolve threats, simple action. You could reject appointments, also resign from appointments due to threats you've noticed during the engagement is allowed. Also, professional bodies enforce codes of conduct like that of ICAN. Provision of non-audit services, you need to evaluate threats. If you are not checking or preparing audit reports, you can provide financial services, evaluate the threats, apply safeguards where possible. ICAN prohibits assuming management responsibilities. This is very important. Also, legal services, recruitment of senior management need careful considerations. Also, making referring people, you need to do that with safeguards, with disclosure fee, monitor quality, verify staff independence before making referrals. This is very important. And referral fees to obtain clients are generally prohibited in Nigeria. So for them to refer you a client, or somebody is referring a client to you, for you to pay him, like marketing, advert, is not allowed in auditing. It's not allowed. So a client should approach you by himself. You shouldn't go poaching for clients and paying people that poach them for you. It is prohibited in our laws. Okay, so that will be the end of Unit 3. A bit long, and we are also our time is up. We're supposed to go on break. It's almost 9:10. So let's go on a short break, 10 minutes break, so that we'll come back and close out on this